Here's a list of the most common small business tax deductions. A small business tax deduction or tax write-off is an expense that you can use to reduce your taxable income. And reducing your taxable income reduces your tax owed. But it's important to remember that a tax deduction does not save you on taxes dollar for dollar. It depends on your current year's tax rate. But you can use about 20 to 25 cents on the dollar as the amount of tax you'll save for every dollar you spend on the following deductions. It doesn't matter what type of entity setup you are, whether you're a sole proprietor, single member LLC, partnership, S corporation, C corporation, those are just entity structures. The IRS ultimately decides which expenses you can use to reduce your taxable income, regardless of your entity setup. And the most important qualifications of the expenses are that they're ordinary and necessary to generate income and conduct your business. The theme of the cost of goods sold and overhead expense categories below are that what qualifies in those categories depends on what type of business you are, the kind of customers you have, and which area of the country you're in. What might be ordinary and necessary for a farmer in Idaho will be very different from a lawyer in New York City and a bakery in San Diego. And this is why it's important to remember that what might apply to one small business owner might not apply to your business. So what expense categories are allowed to be used to reduce your taxable income? Cost of goods sold, which should already be in your profit and loss for the business. And these are expenses that are directly related to the cost of making a sale or generating income. These are allowed to be used to reduce your income generated. And some examples of cost of goods sold accounts are subcontracting, lab fees, album costs, referral fee, merchant processing, shipping, PayPal fee, printing, supplies. Next up, overhead expenses. These should also be already included in your profit and loss for the business. And these are expenses that are ones you'll have every month, regardless of whether or not you make any income that month. So accounts that we often see in overhead include advertising, bank fees, computer supplies, insurance, dues and subscriptions, equipment rental, office supplies, postage, payroll taxes, payroll processing, website, legal and professional fees, bookkeeping, accounting, travel, parking, tolls, meals, continuing education, job supplies, interest, photography supplies, taxes and licenses, rent, software, employee benefits, employee health insurance, repairs, utilities, web development, coaching, licenses, outsourcing, and workers' comp insurance. And that list is far from everything that will apply to you. Auto expenses. Now these may or may not be already included in your profit and loss for the business. So you can reduce your taxable business income by the business use percentage of your auto expenses or the mileage deduction, whichever is higher. There is a lesson specifically about how to calculate this, but if your auto expenses are already in your profit and loss as 100% deductible, an adjustment will need to be made on the tax return to increase your taxable income on your profit and loss to better reflect the actual business expense for the year. Business use of home. This is a tax return deduction only and should not be included in your profit and loss for the business. If you're self-employed and have a dedicated space in your home for your business that is not used at all personally, you can deduct a portion of your home as a business expense. There is a lesson to more specifically describe the different ways you can calculate this expense. But these are personal expenses that you're bringing onto your tax return, so these should not be included in your profit and loss for the business and will only show up on the tax return. Self-employed health insurance. This is a tax return deduction only and shouldn't be included in your profit and loss for the business. If you're self-employed and pay for your health insurance plan out of pocket, you're allowed to reduce your overall AGI by taking this deduction on Schedule 1 of your Form 1040 individual income tax return. This should not directly reduce your taxable income on the books for your business, but it is a tax deduction. Traditional IRA. This is a tax return deduction only and should not be included in your profit and loss for the business. As long as your adjusted gross income your AGI is under the limitations, contributing to a traditional IRA every year is a great way to put money away for retirement. This is a win-win. Your future self will thank you, and you'll be able to reduce your taxable income in the current year so that you pay less in taxes. There's a limit to the amount you can contribute every year, so make sure you know how much you're allowed to put in. But even if you can't contribute the max amount, it's still a good idea to put some money away every year. Self-employed SEP or simple IRA plans. These are tax return deductions only and should not be in the profit and loss for your business, unless you're a C Corp or an S Corp. Each of the plans available to self-employed individuals has its own limitations and requirements, but they both allow you to put away much more money than a traditional IRA does. So if you're already maxing out your traditional IRA every year, you may want to look into setting up a SEP or a simple retirement plan. Health savings account. This is a tax return deduction only and should not be on your profit and loss for the business. Depending on the type of health insurance plan that you have, you may be able to open up and contribute to a health savings account. This is another popular saving mechanism for individuals that max out their IRAs and retirement contributions every year. HSAs allow you to put money in an account that grows over time to be used down the line for health-related expenses. And finally, the qualified business income deduction. This is a tax return deduction only and should not be in your profit and loss for the business. This is a deduction that you'll get automatically, assuming that you use a tax preparer or software to help prepare your taxes. If you use a pen and paper, like my aunt, you're on your own because this deduction is a nightmare to calculate. Included with the tax law changes of 2018 was this Qbi deduction. And as long as you earn less than $400,000 in a given tax year, you can reduce your pass-through business income by 20% without lifting a finger. If you found this video helpful, we're real accountants and CPAs who work with hundreds of small business owners just like you every day. Check us out at engagecpas.com to see if we're a good fit for your business. We also have business courses available to help small business owners understand their business. They're for you to learn about your financials, your taxes, how to pick the right entity, tax myths, and everything else about your business. Learn at your own pace. Check those courses out on the Education tab on our website. You can also find us on Instagram at Engage CPAs.